Tonight on KQED Newsroom, another California bank is in trouble. We talk about the turmoil at First Republic Bank and the collapse of Silicon Valley Bank with Congressmember Ro Khanna. Plus, Uber, Lyft, and DoorDash just scored a big win in the courts. We'll discuss the future of gig workers with our panel of financial experts. And we visit the largest animal shelter in the Bay Area in tonight's look at something beautiful. Coming to you from KQED headquarters in San Francisco this Friday, March 17th, 2023. Hello and welcome to the show. I'm Priya David Clemens. Tonight, we are focusing on the regional banking crisis, which began with the sudden collapse of Silicon Valley Bank 1 week ago. We've been learning more this week about what sparked the bank run and why they were bailed out. Joining us now to discuss the federal government's intervention and the national picture is Congressmember Ro Khanna, whose district includes Silicon Valley. Representative Khanna, thank you for joining us.
Thank you for having me.
We are actually going to start here in California. There was hope that the Silicon Valley Bank bailout would put to rest any concerns about the stability of the banking industry. But just yesterday, another California bank, First Republic, was bailed out as well. And, to be clear, it was bailed out by a consortium of large banks, not by the federal government, but it was to the tune of $30 billion. And today, stock prices are plunging at First Republic. Have you spoken with leadership at that bank?
I have been in touch with Treasury and the federal government. I appreciate the decisive action they took to protect all depositors at Silicon Valley Bank, and that was needed, or you would have seen a massive regional run, and I was advocating for that with the Treasury Department, the White House, senior advisors to the president. I think they're closely monitoring the situation. I appreciate what Jamie Dimon and the bank did yesterday, and I'm confident that Secretary Yellen and Powell will do what's needed to prevent any regional run on the bank.
Investor confidence in banks has been falling precipitously. Even before the latest crisis, index funds were down 15% on the year. After Silicon Valley Bank collapsed, they went down 20%. If Wall Street is disinvesting from the sector, what should the average American consumer take from this?
I think the Wall Street was showing a degree of confidence yesterday, and they were putting a lot of their own deposits, uninsured deposits, with First Republic. And so my sense is obviously there is a challenge with interest rates having risen as rapidly and a number of banks being in long-term bonds, but that this is not 2008 and that the Fed and Treasury Secretary have acted decisively, and I expect things to stabilize. Or if they don't, I know that Secretary Yellen and Powell will take decisive action.
But these concerns have been ongoing for some months. We're just seeing it now, right? And so there's a question of whether or not what happened at Silicon Valley Bank will happen at other banks. With First Republic having these problems so publicly as well, we have to ask, are these the canary in the coal mine?
I think what it shows is a problem with regulation. I was heavily lobbied to deregulate in 2018 and not have these banks subject to the stress test, liquidity test. I voted against that. I voted for stricter bank regulation. And now it seems that we do need that. We need the liquidity and stress tests. We need those tests to be better. My understanding is they're not running the tests with a spike in interest rates. And we need to be asking how the San Francisco Fed can be doing better also in terms of enforcement. That needs to be going forward, I think, the primary issue for Congress.
You mentioned 2008, and it does feel reminiscent in some ways. At that point, the government said the banks were too big to fail, and so it bailed them out. But Silicon Valley Bank is a smaller regional bank. Why did you advocate for government intervention here?
Oh, it's clear I was against a bailout. I didn't think any of the investors should be protected, and they're not. I didn't think any of the shareholders should be protected, and they're not. I think we should claw back the money from the Silicon Valley Bank executives who sold stock and made bonuses and compensation, and I've been advocating very strongly for that. But I thought depositors who just have their money in a bank, they should be protected. They're not assessing the risk of a bank closing, and the danger, if we hadn't protected those depositor funds, would have been that money would have gone all to the 4 New York banks, and we wouldn't have regional banks. Now, unlike 2008, the assets underlying Silicon Valley Bank are good assets. It's not like they made a bunch of bad loans. They made a terrible decision to just be in long-term treasury bonds without a hedge, and they're suffering the consequence. But that's why I don't think it's going to cost the deposit insurance fund money, because ultimately they'll be able to settle the assets in the deposit insurance fund, which is paid for with bank premiums, will be made whole.
And is this not the same concern that other big banks might have used the same sort of tactics in buying up those bonds and then having this problem with the interest rates hiking up so quickly and being caught flat-footed without liquidity?
No, because I think the Silicon Valley Bank was particularly irresponsible. I mean, they got a little bit greedy. The long-term bonds give a higher interest rate, and they put all their money in long-term bonds, and they didn't have enough short-term bonds, and they did not hedge for what happened to the interest rates go higher. And they also had a very non-diversified client base. You look at Bank of America, they've got millions of people with under 250,000 deposits, which are fully insured. Silicon Valley Bank was one of the highest non-insured banks because with very, very large accounts. So if 10, 15 people start to pull out those large accounts, you could have a run. So the circumstances with the bank were particularly bad.
There has been a lot of talk about the hypocrisy of the tech industry, which has fought against government regulation for years. You mentioned the lobbying that Silicon Valley Bank did to not have to do stress tests. But the hypocrisy seems to be no government regulation, but yes, please give us money to solve the crisis. So I'm curious what you think with Silicon Valley Bank as one who's won the right to not have to submit to some forms of federal banking oversight. Is there hypocrisy in this situation, and should it have been rewarded like this?
I think there are many people in Silicon Valley, like myself, who advocated for stronger regulation. I've called for an Internet Bill of Rights. I voted against the deregulatory efforts that Trump had to take away Dodd-Frank from banks like Silicon Valley Bank, as did, by the way, the entire Bay Area delegation. It wasn't my vote. I have called for stronger antitrust enforcement, but this was not about the tech executives or the VCs. This was about nonprofit organizations like Silicon Valley Community Services Center in my district that had over $1 million in the bank to be able to make its own mortgages. They're a food bank. This was about a lot of companies in my district and around the country, AI companies, climate tech companies, defense tech, biotech. These are startup companies, and they would have had to lay off many people or go under. And all we were doing as a federal government is saying if they had put money in the bank, that money should be protected. It's not protecting any of the people who are engaged in speculation.
I want to read a statement from economist Dean Baker of the Center for Economic and Policy Research about the federal intervention, and he wrote this in an email to The Intercept. He wrote, "There is definitely a class element. Look at how easily we can toss tens of millions of dollars at people who couldn't figure out how limits on FDIC deposit insurance work, but the idea of giving $10,000 in debt relief to a student who might have used bad judgment in taking out a loan when they were 18 gets so many people upset about moral hazard and individual responsibility." And, you know, I would argue, and I think you probably would too, that those 18-year-olds are not necessarily all exercising bad judgment by taking out a student loan, and they're certainly encouraged to do that. As a member of the Progressive Caucus and in your own work, you have supported student debt relief and the cancellation of student debts. Talk to us a little bit about the society we're living in right now and why it is so much easier for our federal money, billions of dollars in these cases, to flow to the wealthy rather than to the poor.
Well, I do think in this case, the deposits would not just have benefited the wealthy. I mean, the deposits were there to make payroll. I talked to a company, Rippling, that had 400,000 Americans that wouldn't have gotten paid if it didn't guarantee the deposits. The deposits are for a single mom. There was an Ohio single mom entrepreneur who was a startup founder who needed this to make payroll. But I get Dean's larger point, which is when you have the advocacy of a lot of venture capitalists, tech leaders, a powerful constituency saying we need to look out for payroll, we need to look out for companies going bankrupt, the government can act, and it can act in a few days. We don't have that same urgency in East Palestine, Ohio, in Jackson, Mississippi. We don't have that same urgency when it comes to the crushing student debt or the medical debt that many people in this country have. We haven't had that same urgency for raising the wage or to get child care to families who can't afford it. So I think that the anger comes not about a opposition to the policy, which was correct. We would have hurt working families more if we hadn't guaranteed the deposit, but a frustration that government only seems to work when you get a lot of prominent people or wealthy people screaming for it to work.
Is there a change that you want to see in our system as a result of this situation?
Well, I want to see three changes. First, we need more regulations on large regional banks. Two, we need to strengthen Dodd-Frank, strengthen the liquidity and stress tests to make sure this situation doesn't work. And three, we need to have federal deposit insurance cover payroll, but have banks be charged a higher premium to cover it, and to have a tax on large account holders. People who have more than $250,000 can pay a tax for buying insurance.
Representative, we've discussed the California Senate race in the past here on the show. A few weeks ago, we had Congressmember Barbara Lee on. She was the latest person to enter the race, and she's joining Representatives Adam Schiff and Katie Porter. Where do you stand on the Senate race at this point? Will you make your own run at the seat?
Well, I'm a big admirer, as you know, of Barbara Lee, one of the consistent anti-war voices in the Congress. I've said it's important to me that we have an African-American woman. I have also said that I'll be making an official decision by the end of the month, but that Barbara Lee's entrance would be something I take into consideration. I'm going to be talking to my team next week, and we'll have a final decision by the end of the month.
Shoot, do you mean we should have had you on in a couple of weeks instead of today?
Well, I always enjoy coming on. I'm happy to come back anytime.
All right, Representative Ro Khanna, thank you. And I know you've got a lot of work to do.
Appreciate it. Thank you, Priya.
Take care. In addition to the banking turmoil and stock market ups and downs, we're also seeing another round of tech layoffs. Meta announced 10,000 more people would lose their jobs as the social media behemoth continues to tighten its belt. Joining me now to discuss more financial news are MarketWatch San Francisco Bureau Chief Jeremy Owens and MarketWatch Senior Reporter Levi Sumagaysay. Thank you both for being here.
Thanks for having us, Priya.
Thanks. So, Jeremy, kick us off. Could you tell us more about the broader economic picture that we are seeing right now and how the collapse of Silicon Valley Bank, this cash infusion into First Republic Bank, fits into the overall picture?
Well, it's really the symptom of two different diseases that crashed Silicon Valley Bank, and that is in banking and finance is one of them, right? A lot of these banks made long-term bets back in 2021, early 2022, when the economy was basically a fantasy land. And now we've returned to reality in the economy in a very harsh way, and the rising interest rates have made a lot of those bets look really bad and has created a problem for them in terms of their paying out the going interest rates while bringing in the interest rates of 2 years ago, which were much smaller. On the other end, we have the tech sector, which has more panic and fear than we have probably seen in Silicon Valley since the dot-com crash, right? We're seeing all of these layoffs. We have seen basically the end of a tech boom that has lasted for roughly 15 years, right? Since kind of the creation of the iPhone and the creation of cloud computing back in the mid-aughts. We have had just unending strong growth in Silicon Valley tech, and now that seems to have come to an end, and nobody really knows what comes next after that boom. Is it a huge bust? Is it a slow deflation? Nobody really knows what is going to come next, and that is creating uncertainty. Always creates fear and always creates some sort of panic, and there is no more appropriate way to show fear and panic than a bank run, which is what happened in the case of Silicon Valley Bank. These were tech companies and venture capitalists causing a bank run out of pure fear and panic. And that's because of those two things really coming in together.
And Levi, tell us about who's been impacted here, because you've been doing some reporting into the community served by Silicon Valley Bank. We think of it as the tech community primarily, but that's not the only sort of customer there.
Right. So many people were affected by what happened. First of all, the employees of Silicon Valley Bank, right? This happened over a matter of a couple days. And then the tech community, tech startups, and venture capitalists who told my colleagues and me that Silicon Valley Bank was very unique, served their needs, and that Silicon Valley Bank really made the startup world go round. And so that's a huge thing. Now, also, we have to remember tech startups also need other tech companies' services like the cloud and other software, right? So some analysts are saying that the effects of this could be felt by big tech companies as well and could be felt for years to come. And then finally, Silicon Valley Bank served not just the tech community, it served our Governor Newsom, the wine industry, nonprofits, affordable housing projects. So the impact was felt really widely.
But when you say impacted for years to come, the government stepped in and those customers all now have access to their money. So is there a long-term ripple effect here, ramifications?
So, you know, yesterday Morgan Stanley put out a report that said that they think that a lot of startups are going to go under by the end of the year because of this.
Wow.
Yeah, we do kind of know what's coming next for Silicon Valley Bank, but we don't know if it's going to play the same role in the same way.
Yeah.
Right? It is probably going to change how it acts. And so we don't really know if that role is going to be filled in the same way and what is going to happen after that. Again, another level of uncertainty that is just going to create more fear within the tech sector.
And if there's going to be a single Silicon Valley Bank-like thing that will rise, because, you know, some of the VCs I talked to this week said now we know the importance of diversification and not keeping all our eggs in one basket.
What does this economic environment do to startup funding, particularly for women and people of color? Let's point to this sort of horrendous reporting that we heard about earlier this year, horrendous just in the numbers. Only 2.4% of all venture funding went to women-led teams in 2021. That number actually dropped in 2022 to 1.9%. So there's this tiny, tiny little amount of money that is going to women-led teams. What happens now in the startup environment for women and others who are just beginning new ventures?
Right, right. And more numbers for you, right? So because of all the economic uncertainty that we had even before the collapse, venture capital funding overall was down 36% last year, and venture capital funding to Black-led startups was down 42%. So historically, women and people of color have had a harder time getting funding, and all of this could compound that. And one other thing I learned during my reporting this week was that some tech startup founders aren't comfortable banking with major financial institutions because those banks have a terrible track record of discriminating against Black and brown people, and they've, you know, had to pay millions and millions of dollars in settlements, and it shows, right? So I think it's going to be twofold. Like, one, will founders of startups be comfortable banking at places that are now going to try to take the place of Silicon Valley Bank? And will those banks be comfortable lending to those people?
And will venture capitalists be looking for women and people of color to fund anymore? Right? In these times of fear, they tend to stick with what they know.
Right.
And if you've noticed, the venture capital industry is very male, very white, right? And there are going to be, you know, entrepreneurs getting laid off or leaving these companies. Just look at Twitter, just cut another round of employees, most of them founders that they had acquired. Those, you know, largely white dudes are going to be going out and trying to start a new company. And they have already proven they can start a company. And these venture capitalists are going to look at that and say, I'd rather do that than take a chance on somebody else.
Well, you know, this bank run seems to have been cited by venture capitalists, such as Peter Thiel, the founder of PayPal and Founders Fund, who he's a self-described conservative libertarian, has not wanted government intervention in the past, and he went out there to some of the founders in his companies that he'd invested in and said, pull your money.
Yeah, he sent a letter Thursday morning or had a call with some of his people and asked them, and the Silicon Valley Whisper Network started. And everybody heard about it. And that's part of being out here, right? You start hearing these things, and they all acted on it. And that's what one of the first, you know, matches to the fire of that bank run. And you know, a lot of people have pointed out the hypocrisy of a lot of libertarian VCs asking for a bailout. What I really look at is Silicon Valley Bank would not have gone under without the bank run. It had what it needed to. It had an equity investment locked down that would have overcome what it was facing. And then the bank run is what torn apart. And on the other, with the shoe on the other foot, you know, the investors and Silicon Valley Bank would not run from a startup that had a bad bet and had to sell some equity to cover up that bad bet. It happens all the time. You know, the example I use is Uber dropping billions into autonomous vehicles, realizing they were still behind and never would use that, and sold at a huge loss that AV unit they had developed. Nobody ran away. The company didn't go illiquid. You know, the stock barely showed. I think the stock went up after they sold it because people realized they weren't going to be losing money anymore on it. And so I really, you know, there are a lot of people to kind of criticize in this moment. I really do think the venture capital community might be number one on that list.
All right, let's turn to some other news. Proposition 22 had a big week in the courts. Now, this was the proposition that voters determined gig companies such as Uber, Lyft, DoorDash could classify their workers as independent contractors. There was an appeal, and the courts this week said, yes, Uber, Lyft, DoorDash, you win. You get to keep classifying your workers in that way, assuming this is going to head to the California Supreme Court at this point. Levy, is that right?
Yeah, I can't imagine that it wouldn't be appealed all the way to the California Supreme Court. That's the next step. Yeah, the gig companies, major victory for them this week when an appeals court upheld most of Prop 22. And so what that means is that of course, they can keep classifying their workers as independent contractors instead of employees. And what that could mean for California, if the California Supreme Court upholds this ruling, is that other companies could try to gigify their workers. They could try to adopt the Uber model to try to save money and you know, try to turn their employees into independent contractors. That's one thing. The other thing is that you know, the companies have said that they want to spread the Proposition 22 model elsewhere. So if they win in California, it's a big deal, and they could try to, you know, expand that model everywhere.
And the California Supreme Court will be very interesting because what started this was AB 5, which was based on a California Supreme Court ruling. So basically, all of this is started by the Supreme Court. We had AB 5, then we had this
which
Prop 22.
Was, as a reminder,
that was the new labor law that required all of these companies to treat their drivers as employees. And then Uber and Lyft were able to pass this proposition that said, no, but you can continue to send them as ICs.
Overturning AB 5.
Right. Well, not really overturning AB 5. It's an exception.
Exempting them from
exempting them from California labor law, right? And so the Supreme Court is the one who basically started that process. And now if they get this case, it's going to be fascinating to see what they think about it and if that lives up to their previous ruling.
So we'll be watching it for national repercussions as well, it sounds like. But your reporting has also had a very personal effect, and you helped a deactivated worker. Tell us about that.
Yeah, sure. So when you're a gig worker, you can be deactivated or basically kicked off the app at any time. And that's what happened to a Massachusetts Uber driver that I was speaking with for another story. And when he told me his story, I was fascinated because Uber basically asked him to prove that he was at the airport waiting to pick up a passenger. And so he was asked to send a photo. He sent a selfie, and for some reason the photo showed metadata that indicated he was on an island somewhere else. So Uber deactivated him. And so he went to Uber and said, there was no way I could have been on that island because cars can't go on that island, right? And so, but Uber still deactivated him. The other really fascinating part of the story is that last year he spent $180,000 to try to start an Uber Black business. Uber Black is Uber's premium service. Think black cars, luxury vehicles, right? So he had bought 2 vehicles for that purpose. He had gotten a commercial license, and he was trying to basically start his mini fleet, but Uber kicked him off the app. And so I went to Uber. This happened in December, by the way. He was deactivated in December. I went to Uber. I just spoke to this guy in March. So he had been deactivated for a few months. Within 2 days, Uber had changed its mind and reactivated him. And I just want to say that, you know, I've also reported on other deactivations, and I think this is a systemic thing. A couple of dozen other gig workers have already reached out to me after reading that story and asked me to take a look at their story. So I'm starting to sort through those now.
And realize that Prop 22 is going to do nothing about that. There are no laws really yet about deactivations. Illinois, is looking into a law setting some kind of baseline for how those deactivations happen. But right now, Uber has and Lyft have complete control over that.
All right, Levi Sumagaysay and Jeremy Owens from MarketWatch. Thank you both for being with us today. I appreciate it.
Thanks so much, Priya.
Absolutely.
For more than a century, the San Francisco SPCA has been at the forefront of animal welfare advocacy. The organization is the largest shelter in the Bay Area, and it was the first cage-free animal shelter to be established in the United States. Join us as we visit the SF SPCA for this week's look at something beautiful. That is the yappy, happy end of our show. We wanted to let you know that we had planned to speak with Mayor Sheng Tao tonight, but she had to reschedule and will join us next week. We'll also be joined next Friday by the CEO of One Fair Wage, Saru Jayaraman. If you'd like to share your comments or questions for our guests, you can email us at knr@kqed.org. You can also find KQED Newsroom online or on Twitter, and you can reach me on LinkedIn at Priya D. Clemens. Thank you for joining us, and have a great weekend.